Hey, welcome to another episode of Market Noise. Thanks very much for jumping on, whether you're live with us on YouTube or you're listening on the podcast. It's fantastic to have you along, and thank you very much for giving us some of your time. Now, as you guys know from last week, we're having a bit of a rotating chair of guest hosts, and this week I've got a good friend of mine, Andrew Dresner. Andrew is a financial planner at Mercury Wealth. And he's also a partner of mine in Sprout Financial, which runs our license. So firstly, Andrew, g'day, and thanks for giving us some time and jumping on the line.
Yeah, no dramas, Paul. Good to be here, mate.
Good stuff, good stuff. Well, we'll get you to lead things away because you are a bit of a crypto nut, and there's a bit happening in the Bitcoin ETF space this week. So hit us with that story.
Yeah, so look, it's fascinating times at the moment. I wasn't always a crypto nut, so I'm a pretty recent convert, as you know. And I think the more you look into it, the more interesting it is. So, there's some very interesting news in the last week or so around the sort of the launch of a Bitcoin ETF in the US. Now, this is not a recent thing in terms of that the companies have applied for. I actually read something the other day where it was 10 years ago where the first ETF was applied for. So it's taken a long time before it's approved. Now, the one that got approved last week was actually ProShares. So they were the first to launch. I guess the main thing to comment about this one is it's based on futures. So they don't hold Bitcoin as such. So they don't necessarily have to go out and buy the Bitcoin. Essentially, they're trading futures contracts. So look, it'll be fascinating to see, I guess, the impact that it's going to have and how it interacts with, the Bitcoin price.
I understand the volume's been pretty high. Have you seen much on that?
Oh, look, it was amazing. I think it was up one of the best debuts ever for an ETF.
Yeah,
I think within the first 2 days was $1 billion, which is incredible in terms of volume. Believe it or not, since the first one launched, there's been another two. I think the Valkyrie launched on Friday, and that wasn't as good in terms of, I think, the figures. So I think that the first one through ProShares, they probably stole a lot of the thunder. And I think there's another one coming out even, I think, tomorrow, sort of US time, which is a Van Eck. So these are all
based on futures?
Yeah, these are all futures. So I know there's about 20 odd different ETFs which are in the application phase, and some of those, around half of those, are for spot Bitcoin. So it just depends. I mean, hopefully this will be the first one that comes through, and then the SEC will allow the others. I think they're just sort of testing the waters because the SEC is obviously, they want to regulate these things, and they can regulate, the futures essentially exchange. So look, it'd be interesting to see how it goes. There are positives and negatives to this. I guess from a sort of a positive, it gives people an introduction to crypto who may not have been in there before. They might want to hold the custody of Bitcoin themselves, maybe scared about, losing their keys or what have you, or don't understand how to do it. So it's more of an introductory thing for them. I guess the other big bonus, which I saw, was the number of financial advisors in America which now have access. So I think it was 218,000 financial advisors now have access to, recommend this for their clients over there. And you're talking about they manage around $110 trillion, which is some pretty serious money.
And this is the interesting thing. Like, there's a bit of talk around for the people that are familiar with Bitcoin. They're like, what do we need this ETF for? If someone wants to invest in Bitcoin, just go and buy it through a regular exchange, right? Which is all very well and good if you're familiar with it. But there's a ton of people who are not comfortable setting up an account with a Bitcoin exchange or a cryptocurrency exchange, as you say, lost keys and just various issues, custody issues. But they've all got some sort of facility to buy shares, to buy ETFs, that sort of stuff. And if they could buy Bitcoin exposure just as easily as they could buy the S&P 500 exchange traded fund, it's got to open an enormous potential volume of acquisitions, isn't it? An enormous amount of money that could be invested into the space.
Well, I mean, that's the other big benefit. I mean, because that's what it allows them to do. Anyone with a brokerage account can now go buy this ETF or one of these ETFs. So look, it'll be fascinating to see if it does, it was more sort of, buy the rumor, sell the news, I think. So there's a bit of a sort of run up in Bitcoin over the last sort of couple of weeks. and it's actually come back a bit now. So it'd be
Well, that
fascinating
actually
to see
fits.
how that works.
Yeah, for the people watching the YouTube program, I've got the chart up on the screen at the moment. So what I've got there, the blue is this new Bitcoin ETF, and the gold there is the actual Bitcoin US dollar price. Because initially I just wanted to put this together just to see, well, how closely does the ETF track the Bitcoin price? And it's not precise, but it's pretty good. I mean, it's very early days. But, you know, given that the ETF is actually tracking the futures and not the spot price, you know, there should be a little bit of a difference. It feels a little bit of an imperfect solution, really, but it's what they're going with at the moment. But the other thing that chart shows, exactly as you said, Andrew, is, yeah, the price has come off a little bit in the last couple of days from where it was. So, yeah, a bit of momentum going into that announcement, perhaps. What do you make, because you're across this more than me, what's the futures element? What does that mean practically for investors? Like, could you ever have a situation where this ETF and the futures price diverges massively from the underlying spot price, or are they always going to be reasonably aligned?
Look, I think there is that potential. I mean, you would have seen yourself through other ETFs, like gold ETFs and things like that, that they don't necessarily track the gold price. And it can, you know, it can be way above or way below. So that's the thing. That's why spot ETF is the thing that's really going to impact the price, and that's going to drive the demand, and that will be the killer. You know, that's really going to push up the price. Whereas this, it's a little bit unknown, because a lot of people thought, you know, it's going to pump it to the moon, you know, once this thing comes in, and it hasn't necessarily been the case. So, like you said, it gives people access who have brokerage accounts. It's more of just an introduction, you know, until they get used to it. I mean, it's only one crypto as well. You know yourself, there's, you know, 12,000 odd cryptos, and this only gives you exposure to Bitcoin. You know, so it's only giving you exposure to the main one there, where you've got all those other alternative assets as well.
That's an interesting point, because, yeah, in the run up to this ETF getting launched, Bitcoin was getting all the love in terms of the prices, and you know, your Ethereums and others sort of weren't doing very much at all. But it's almost since that launch, it's like Bitcoin sort of stepped back a little bit, and some of the others have got a bit of love. So it does make me wonder: is the market starting to think, all right, well, this Bitcoin one went off okay, Ethereum's got to be next, and on it goes from there. So yeah.
Well, I know some of the fund managers have applied for, I think, Ethereum only as well. So there are some other sort of assets which may follow. Maybe Bitcoin's the first one. So we'll see how it goes. Be very interesting to see.
It's like I said, the biggest one.
Yeah, I mean, it's mainly negatives. Mainly positives, I would say. I mean, there's a few negatives because, you know, I think the MER is about 0.95.
I was going to say that it's ridiculously expensive ETF, but I guess if you get in first, you know, make a bit of cream, and then you drop the price once you got some volume, I suppose.
Well, I think the third one that's coming out, which is the one today or tomorrow, the Van Eck, that's about half that price. So it's a fair bit cheaper. So, you know, maybe they'll get a bit of a competitive advantage with that. Once again, we'll see. Maybe someone will come out with a blended one where they have a few different assets within it. But look, mainly positive. And I think probably the SEC just wants to see how this one goes. And then they may release a sort of spot ETF towards the end of the year or next year if the whole thing doesn't blow up. So, you know, they're just being conservative, I think, in their approach.
Interesting. All right. Well, thank you, Andrew. It's I mean, Bitcoin ETF. We've been throwing that around on Market Noise for a while. I think a lot of people have been looking forward to when that might happen. And yeah, this sort of, as I mentioned before, it's an imperfect solution the way they've done it with futures, but it's at least a bit of an exposure. And yeah, $1 billion flowing in within the first couple of days shows that there's definitely interest and demand there. So it's an interesting step in the whole crypto space. I guess somewhat related to that, there was one that I picked up this week, keen to get your thoughts, which was that Senator Andrew Bragg, this is federal government, put out some recommendations around cryptocurrency. He's done a report of the Australia as a Technology and Financial Centre Committee. And it's been really well received across the community, you know, the sort of crypto type community, blockchain type community. It's talking about how in Australia we might be able to regulate crypto exchanges, which would be quite significant. And particularly, talking about comparisons with Singapore, which is considered really the leader in terms of licensing of crypto exchanges and some of these sort of things, bringing the regulation in, that were Australia to adopt some of these recommendations, that Australia would sort of leapfrog and potentially be a leader in the world for this sort of space. One of the interesting things too, they had in there the decentralized autonomous organizations, or DAOs, which if you read a bit about cryptos, get talked about quite a lot. There was one recommendation in there that they could be recognised under the Corporations Act, a bit like a proprietary limited company, which would absolutely put Australia at the forefront. And it would be really interesting if that come to play, how many businesses in this space would then choose to domicile in Australia to take advantage of that. Did you have a bit of a read of this one, Andrew? And if so, what did you make of it?
Yeah, I mean, the way I look at it, I mean, some people look at regulation as a bad thing. I think regulation can be a good thing if it's clear and concise. And you know yourself, but before anyone wants to invest, before they want to set up a company, they need certainty. And so if we can have these rules and regulations in place, which are common sense rules and regulation, then it's only going to be a benefit to Australia. And it's going to put us, ahead of the curve. I mean, the problem is the regulators have been behind, I guess, this space, because it has been changing so rapidly, in terms of how the assets are treated. You don't really have that clarity. I mean, at the moment, from my understanding, everything essentially is a capital gain or loss, depending on how long you hold the asset. But it's a little bit unclear in terms of, well, what if you do something else with the asset, in terms of whether you farm it or whether you lend it out, in terms of how that's treated from a tax perspective. So it can get pretty complex, and, it'd be great to have some certainty around it and have a little bit more protection for people, because at the moment, those exchanges, I think pretty sure all they have to do is, the reporting for anti-money laundering, and that's pretty much it. They don't have to follow too many other rules and regulations, which is a little bit disconcerting if they've got billions of dollars of assets. I'm pretty sure I saw CoinSpot had 2 million customers just the other day, which are one of the biggest.
Yeah, they're running their Lamborghini promotion.
I did enter that twice. Yeah, I entered that twice. So I don't know how that'll go here, driving the country roads, but we'll give it a crack.
Yeah, might not go too well at your place. But I mean, well, there's a couple of good points you raised there. The tax element. If Australia can regulate these organisations and this space, then there's the potential for more tax revenue to be collected, which can only be a good thing for the country. And in terms of, because I guess, say, the crypto exchanges, and there's several big ones. There's BTC and CoinSpot in particular, I know. But it'd only take one, and I've got no idea, but they seem to be quite reputable and quite diligent. I've interviewed the CEO of BTC actually on the podcast, Financial Autonomy podcast. No due diligence, but they seem to me to be trying hard to do the right thing. But it would only take some sort of fly-by-night company to sort of pop up, do a bit of promotion, and then rip people off, or do something wrong, and confidence in the whole sector would just be destroyed, wouldn't it? So even for the existing participants, and just the comments from in this article in the Fin Review about this particular report, they're all for it as well, because they want to be surrounded by people that are reputable and that are regulated and are licensed and these sort of things, because it gives them protection as well. So within the industry, they're on board. It's not like they're saying, no, we don't want to be regulated, which is really encouraging, I think.
Yeah, look, it always helps the legitimate players, doesn't it? Because, I mean, at the moment, there's very few regulations in place. So, I mean, no one's licensed to give crypto advice, really, whether they set up a YouTube or what have you. And they could, like you said, recommend, an investment which is essentially a rug pull, or, recommend you invest in some exchange that pretty much doesn't exist, and then your money's gone. And there's no ability for investors to get that money back as it stands at the moment. So it's very much buyer beware. So a little bit more regulation in this case would be good, I think, so long as, like you said, if it's not heavy-handed, it allows these businesses to open up and expand here, I think it'll be a positive.
Could be really exciting, couldn't it? And just a reminder, guys, if you're watching this live at the moment, chuck in your comment, because we can see your comments when you type them in, and we'd love to have you participate in the discussion too. So jump on there and share your thoughts if you're listening along. All right, let's switch gear. this interesting piece that I came across. It was talking about the potential turning point for renewables, and I just thought it was quite interesting. And I guess the analogy is, the organic fruit and vegetables, right? It's lovely to do, but it costs twice as much, and so actually the vast majority of the population don't do it. Now, renewables, of course, the cost has been coming down and down and down, but nevertheless, there was still a perception that particularly coal was still cheaper, and renewables was almost a bit of a luxury item for people in the inner city or these sort of things. But this was just a piece that touched on the energy crunch that we're seeing all around the world at the moment. Coal prices in China soared to record highs, and in the US, they're on track to burn 22% more coal in 2021 than they did the year before, and that's the first time they've burnt more coal, year on year, the increase since 2014. So fossil fuel prices are going up and up. We're all seeing that. Petrol prices, Ethan and I discussed that a little bit last week. He was disgusted with how much he had to pay to fill up the car. Fossil fuel prices are going up, and so it just makes you wonder how far off will it be if we're not there already, where the renewables are actually the low cost option. So then it's not just we should move to renewables because it's the right thing to do for the planet, but actually even just the hard-nosed accountant / economist type person who all they're thinking about is the numbers. At some point it feels like, and maybe we're not too far away, where just on the numbers it makes far more sense to go renewables than fossil fuels anyhow. What's your thoughts there, Andrew?
With that, I mean, in countries where it's been successful, so you've got countries like Germany and what have you, which have quite a large percentage of their energy which is generated through environmentally sort of friendly means, but a lot of that was built on, I guess, government support initially, like you said, to get to that break-even point, and that the government subsidies and what have you, they really assist why that cost is coming down. I mean, because I saw something similar. I think I saw something in Europe where the price of gas was basically just going through the roof. So it's across the board, and I think that's probably hasn't been reflected in inflation figures or anything else, that the cost of all these things are rising. And I think, like you said, there's going to be a point in time, when it is just as viable, or even if it's not. I think that's probably something the governments need to invest in initially. I think today, didn't they have an agreement with the Nationals that they wanted to be, net zero by 2050? So you've got to find a way to do that.
Yeah, no one knows what's in the detail. But I guess that's what I'm getting at. Like today, in Victoria here, and I know it's the same in the other states, the state governments have been subsidising people getting solar on their home, right? They give rebates for solar panels and these sort of things. But they've had to do that because the renewables are too expensive, or more expensive than just people sticking with what they've got. But this particular piece was suggesting, and I get it from just seeing the prices floating around, that actually maybe that won't be required for that much longer. So maybe, other than the government not being in the way, maybe those incentives won't be needed for that much longer, which is really quite encouraging, and it'll be interesting to see where it sort of takes it and where it takes industry as well. Because there's always, in Australia, potentially could have some big industries in renewable. We spoke last week about the potential for hydrogen in Australia, and the New South Wales government's investing a lot into hydrogen. Of course, we've got lots of solar potential capacity. There's always the thermal, which they can never quite seem to get to work. But I mean, Australia is blessed with a lot of fossil fuels as well, of course, but potentially we're blessed with a lot of renewable energy as well. And if we've got ways to export that, probably hydrogen being the most obvious, it could be really exciting for our future.
Well, it always makes good sense to have a mix, doesn't it? You don't want to be relying on one source. Because they've all got their pluses and minuses. I know sort of, Adelaide's or South Australia's had some issues in the past when they had, too much solar in terms of consistency of the power and things like that. So there has to be that mix. So look, once again, I think it is a potential thing to focus on, and that's where the world is headed. I mean, there seem to be a lot of companies overseas like Tesla and things like that with their electric vehicles. And that's sort of where they're headed here. It'd be great if we could do the same.
Yeah, agreed. Oh, well, fingers crossed it's something that's able to happen. All right, let's have a look. What else have we got here on the doc to have a chat on? Actually, this one was interesting. So most of the listeners and the viewers will be familiar with some of the investment apps. So Raise, CommSec Pocket, saw Spaceship got a bit of a write up on the weekend. So they've been around for a while, and particularly a piece here is talking about banks trying to gear up to catch CommSec is particularly what they're interested in here. And it's a report by investment administrator Cachet. They found that Australia's big banks are well behind US and British counterparts in offering mobile app-based investing and financial advice services for the influx of young and new investors during the pandemic. So they're just sort of highlighting Commonwealth Bank's got its CommSec Pocket, and that's it. None of the other banks have really done anything about it, which is quite different to the US and the UK, where pretty much all the banks have some sort of solution along those lines. And it's talking about the fact that it's looking, and I'm just trying to find the actual piece here where they get into the detail. Anyway, some of the banks kind of didn't want to make any comment, but essentially it was sort of suggesting that NAB and ANZ in particular, they don't comment about Westpac, were on the cusp of sort of making some announcements there and bringing out some competitive products to compete with that CommSec Pocket. Have you had a play with these sort of tools at all, Andrew? And what did you make of it?
More sort of the overseas ones, I think, more than anything else. I mean, obviously the sort of eToro type. It seems very similar to the eToro type app, so maybe they're playing catch up there. I know CBA's, out of all the banks in Australia, has probably been the best one in terms of their technology. And they've always spent a lot of money in terms of upgrading it. And maybe the others are just playing catch up. They probably just don't have the capacity, I think, at the moment.
CBA was there early just with CommSec generally, weren't they? Like CommSec was a game changer when that came out. I guess it's 20 years ago now, I'm not quite sure, but it went from $100 a trade to $20 or $30 a trade. It was a big deal when it came out.
Yeah, that's right. So I mean, look, this one's obviously, and what they've got, that I think that RAS is pretty interesting in terms of, given it's almost fractionalization, isn't it? You have to let people buy small amounts, and maybe they can set up a regular sort of savings plan and things like that. So I'm not against it. I think it's probably a good thing once again to get people involved, particularly younger people who don't have that much money, even if they can invest $50 a week or whatever the case might be. I think there's 7 odd ETFs or different ones they can invest in. So it gives you a good chance to sort of just build up over time. So it's, and that's the way the world's headed, because people are used to using those online apps, whether it's to buy crypto or shares or whatever overseas. So, I think the banks here need to do it. Otherwise, they're going to be blockbusted, aren't they, in terms of missing out on these things. So we'll see. That's
right. And that's where it'll be interesting, just sort of how these things come together. Like, we talked about the potential for crypto to be regulated. If that did get regulated, you could imagine, I mean, the banks aren't probably going to be the first one there, but it's a matter of time until you get a Raise or a maybe a more detailed CommSec Pocket, because CommSec Pocket is pretty simple. But at the moment, Raise, you can do a little bit of Bitcoin exposure, I think. But if you could get an app where you could buy ETFs, you could buy stocks, you could buy crypto potentially. There might be other bits and pieces that you can get involved with. It could be a bit of a killer app, I think, particularly for sort of people under 40, I guess, especially who are most kind of comfortable dealing with apps and that sort of stuff. It could be quite a strong one, and you'd think it would get a bit of traction. And so it's kind of surprising, really, that the banks aren't there, and they touch there on advice as well. There's a few sort of digital advice players, but certainly that market seems wide open. No one's really mastered that. And so with the banks exiting face-to-face financial advice, you'd imagine it's a matter of time until they make some investments and get the ball rolling on some sort of digital advice solution. They've got the customer base there. If they could come up with something that worked on at scale, you'd imagine the banks would get to it, because I understand that's sort of how it's unfolded in the UK, where they've been on a similar trajectory to Australia, where the number of financial advisors is sort of halved or something like that as a consequence of the big banks deciding to exit. And then the banks have popped back up with digital offerings. But Australia, thus far, we seem to be lagging behind a little bit there. So, yeah.
I think we probably are. We're probably about 2 years behind, though, in terms of the regulations and things like that. So theirs, which were very similar to ours, which came through. So maybe it's just a time factor. So, that'll start to appear the next sort of 12 or 18 months. Where the banks will bring that out, sort of a general advice model, I guess. Rather than specific advice because of the regulations here. So.
Yeah, be interesting to see what they come up with. Now, you had a piece here on WeWork. What's going on there?
Yeah, so, I mean, WeWork's a fascinating story. I mean, that was probably one of the best. I was watching TV, I must admit, the other day, and best documentaries I saw was on WeWork. It was actually from a couple of years ago when they tried to list. So it told you that the whole story of WeWork in terms of just the culture behind the company and looked like a cracking place to work. It was just obviously pretty full on in terms of working mega hours, but it's almost like the Burning Man type festival. That was seen as the workplace. But I noticed recently, it was just over the last sort of couple of days that they've managed to, have a merger and essentially list. It was through a special purpose acquisition company. So it wasn't like the listing they tried a couple of years ago. So it values the company at about $9 billion. And once again, I think from a couple of years ago when they tried to list, the initial valuation of the company was around $47 billion. So it's obviously a bit of a
and that's only 2019. I mean, I know we've had COVID in between, but 2 years ago, it's not that long. They were trying to get away, US dollars, 47 bill, and now they've listed for 9 billion. That's...
Well, it was obviously interesting in terms of the multiples they were trying for because they were selling themselves as, I guess, an IT sort of, solution or firm. But when I look at it, it's just essentially shared office space. That's all I understood it to be.
Yeah.
I didn't think of it as anything more than that. So the multiple must have been massive to try and get that. So once again, they were just tarting themselves up maybe as, a Silicon Valley type play. But in reality, it's shared office space.
Yeah.
So, it's probably more accurate valuation now. I think they're trying to obviously, they had a new managing director come in to try and spice up the business a bit. And just, and they're doing all right in terms of, I think, revenue. So the first half revenue, at 1.2 billion. I think they're expected to do 1.5.
So they're making a profit on that, or?
Yeah. Well, I don't actually know in terms of those details there. I didn't see that in that article.
Okay. It's just, they tell you the revenue. That's I don't know.
Yeah, that's it.
The revenue, but not the profit, kind of suggests to me maybe not. But
it's IT profit. You don't need profits, mate. Don't worry about profits.
Just get in the way.
Yeah, that's right. That's right. It's all about synergies and building and number of users and things like that. So the profits will come later. So look.
Yeah, sorry, you go.
So, I mean, I think they're trying to do, have more sort of, it reminded me of a gym membership. So they were trying to have sort of, longer term sort of membership where people rent out space for, 6 or 12 months or more rather than sort of month by month model, so it'd be interesting with COVID because obviously no one was going in the office and they'd be reluctant to go in now. So it'd be interesting to see how the company does.
Interesting. I've just popped up on the screen the share price since it listed. It's done well. Look at that. It had a real pop on. Looks like on the second day, but it seems to have listed about $11 ish somewhere, and it's at 12 something. It's a bit microscopic. Oh, here we go. $13 now. I can see. So it's listed okay. Funnily enough, you can see. You might see on the bottom of the screen there. It's got the CoinSpot Lambo promotion that we were just talking about too. It's right. Bloody Google. It's listening all the time, isn't it? Look at that. Drops in the ad that we were just talking about. That's bloody amazing. But yeah, I mean, WeWork, I haven't seen that show that you talked about, but for the podcast listeners, if you haven't listened already, there's an awesome podcast called We Crashed. That is a 8-part series that looks into it as well. And I just found it absolutely fascinating. There's just a leader there who's sort of like the guru. Yeah, very much. Yeah, like some sort of guru. And just, I don't know, seems to pull the wool over everybody's eyes to the point where he almost gets this 47 billion valuation listed. It doesn't happen. And then they pay him like $1 billion or something to go away. So he's still
600 million. Yeah, that's what I saw, 600 mil or something like that. So.
Absolutely incredible. But the actual underlying idea, I think, is a really good one. And I would think, particularly post-COVID, even more so, because it's sort of proven that, hey, You don't need to go to the office. You can work remotely. Well, if you can work remotely and say, thinking about Australia, if you worked for a business whose head office is in Sydney, but you're in Adelaide, well, in the past, maybe you couldn't have even gone for that job. No, the role's in Sydney, be here or you miss out. But now you could go for it, still live in Adelaide, and just go into a WeWork type office. And it doesn't have to be WeWork, it could be a competitor. But the idea of that communal office, you still get people around you, and that sort of, you're not stuck at home all the time looking at the same four walls. You know, you're getting out and about. But it feels to me like it's just a really good fit. And post-COVID, I would have thought that would be a really good business, but it's hard to look past that baggage of kind of where it was. But I don't know. I mean, the share price has popped, so maybe enough people are looking.
Yeah, I mean, once again, I think that's 9 billion is probably a more realistic price. I mean, it'd be interesting to see what the multiple is, like you said, in terms of, you know, the revenue and the earnings. So to see that more detail, which I haven't gone to in any sort of depth there. You know, to see whether it's going to stack up longer term. Like you said, I think it's a good idea. And maybe that the larger companies aren't, you know, they don't want to buy buildings now. They don't want to be in the CBD. They don't want to have those large sort of long-term leases. So it maybe work out well for them. You know, they can have a 6 or 12-month lease, you know, with these guys. And, you know, they're committing to a professional office, but don't have to have those massive overheads. So it's going to save them a lot of money.
And even, I mean, you and I, right? We're both running businesses. Therefore, we've got to have an office. We've got to have it kitted out. And you want it kitted out in such a way that it looks professional for clients that come in, but you also want it to be an attractive place to work for your staff so that your staff want to continue to work there. And if you want to hire people, they come in and go, oh, this is a pretty cool place to work. This is where I want to be, right? And it's actually quite hard work to keep your office up to date, looking fresh, you know, giving the joint of paint and replacing the carpet and all this sort of stuff. It's bloody work that, frankly, who can be asked, right? If you're the average business owner, that's not your core thing that you're really that interested in. But it's quite important, actually, to the business. So if you could have one of these WeWork type solutions where they take care of the place look and schmicko and yeah, appealing to potential hires and that sort of stuff, I think it's a really good idea. Anyway, look, let's sorry, you want to wrap that one up?
Yeah, look, I mean, I know some other sort of professionals who do use something similar to that. You know, they're based in Sydney. You know, essentially they work from home, but just whenever they need to, they go into the office. You know, so and it works. So, like you, I think it's a good solution.
Could be really motivating too, I reckon. You know, if you're in an office and there's different people running different businesses and that sort of stuff, and you just have a chat with them on a Friday night over a beer, I don't know, I'd be right up for that. Look, I want to change tack quite severely here because I'm going to talk about the bond market, which is usually something that would put people to sleep. And maybe this one will, but look, let's hope it doesn't, Andy. Let's hope it doesn't. Because it's been really interesting. Now, the Reserve Bank has been clear for, can't say exact, but somewhere around 12 months, that they've cut interest rates to 0.25 is the official cash rate, and it is not changing until 2024. They've repeated it again and again. The cash rate is staying at 0.25 until 2024. Now, they've been buying bonds. They've been doing quantitative easing. And so they can fiddle with that, of course, but the cash rate is going to stay at 0.25. Now, despite that, the bond market is essentially trying to call their bluff, because the bond market, up until Friday at least, certainly as of Thursday, had priced in 2 rises, so 0.5% rise, by the end of 2022. That's what the bond market was saying would happen. So the bond market is basically saying, Reserve Bank, you might not want to move interest rates until 2024, but we think you're going to have to. And, you know, they've got some basis for that. The New Zealand Reserve Bank has raised its interest rates. The US they're not talking about raising interest rates, but they're certainly going to stop, they're talking about tapering, stopping their quantitative easing. So there's a bit of sentiment around, and I guess there's been a belief that the Reserve Bank is just not going to be able to stick to that advice or that guidance that they've given, which will be quite significant, because that's a key tool that the central banks all have, is trying to sort of point markets in the right direction by saying this is the way we're going to go. So anyway, the bond market has been calling the Reserve Bank's bluff. Well, the Reserve Bank fought back on Friday. They went in there, they bought $1 billion of bonds, and they achieved exactly what they wanted, because it pushed the price down, which meant that it got to within 0.1% of their target anyway. succeeded in bringing the yields down. Now, of course, that's not to say that in a month's time it's still succeeding, but at least in the short term it succeeded. And $1 billion of bonds is certainly sending a signal to the market that, hey, you might not think we're serious about this, but we are totally serious about this, and we're going to make sure that what we say happens. And, you often hear on the markets, don't bet against the Fed in the US, and people sort of, oh, well, would the same apply to the Australian market? But I just thought this is an absolutely fascinating one. Can the Reserve Bank of Australia fight against the markets? Does it have the firepower? Can it actually do what it says it will do? And well, they've had a fair crack. $1 billion of bonds is no small effort, and at least at the moment, they've won. Did you come across this one, Andrew? And what did you think?
Yeah, look, it's fascinating. It's almost linear, isn't it? Either the market's right or the RBA are right. There's so it's fascinating because obviously the RBA are looking at inflation and saying that the inflation figures are pretty mild in Australia. I'm just not actually convinced that they're looking at the right thing, because I think the true inflation rate is probably far higher than probably CPI or the core inflation. And I think maybe that's what the market
suggest that.
Yeah, I mean, if you just anecdotally, if you talk to clients, you ask them how they're going compared to last year, and all of them say it's harder in terms of expenses. They can't put the figure on. They're not saving any more than last year. This is pre-COVID type times when they were allowed to, go out and do things. So it's not like they have significantly more. It's not like prices are going down. And like you said, property prices are going through the roof. Share prices effectively, they're pumped up depending on how much, bond buying the RBA does.
I mean, Australians are wealthier than ever. There's hard data on that, and the same thing in the United States, right? Because property prices have gone up, share markets have gone up. So
I think it's pretty disproportionate, though. I think for the average salary and wage earner, it's not the case. I mean, I saw something interesting the other day where in the US, that it was 10% of the population owned 90% of the shares, the value of the shares. So that's how disproportionate it is. So, this has benefited people who own shares, but not everyone owns shares, and not everyone owns property. So if you don't have those assets and, your rent's going up, or the cost of, like you said, petrol, cost of insurances, cost of everything else, it's all going up far higher than what they're quoting as inflation. And so that's why I think the market is saying at some point in time, the RBA is going to have to increase rates. Otherwise, inflation is going to be, running out of control. So look, it'd be interesting to see. I know, and like you said, they've done it in New Zealand. They're talking about doing it in sort of other countries as well. And it's sort of across the world that the inflation's going up, and for far longer and far higher than what the reserve banks of the world think it is.
It seems like a really bold call for the Reserve Bank to have gone that far out to say, hey, rates are going to, we're not only we're cutting rates, but we're going to keep them this low until 2024. Like, a lot can happen over that many years. I'm sure they announced that in 2020. So they've announced that 4 years. Well, yeah, I wonder if they haven't sort of gone a bit too...
They probably have.
They're a bit overconfident, Can they really shout out 4 years in advance where the appropriate interest rate should be? It feels almost a bit arrogant.
Yeah, look, I think they'll probably have an out. They'll probably say if the data backs us up, so something changes. I mean, I think the US is going through exactly the same thing. Like I said, I think most countries are. And, they had a really high inflation number. And they said, I think the words they used was transitory. So it's transitory,
Yes.
It's just temporary sort of thing. And now they've turned around and they go, oh, it's not as temporary as we thought it was. Things have obviously changed. So that's when they may par back on the purchasing of the bonds, and then eventually raise interest rates as well. Because you're right, you can't say it 4 years out. You don't know what the future's going to hold. And these guys don't have a crystal ball either. So I think it's a pretty big call. I think it's more to provide that certainty. When COVID was on, they want to say to people, hey, it's all right. You don't need to sell your houses. You don't need to, do anything drastic, because that's almost self-fulfilling prophecy that if everyone starts selling at the same time or cuts back on their spending, then, it sort of falls into a bit of a recession or a hole.
And I think it was just across the board when COVID hit. All our memories rolled back to the GFC, and that was this prolonged death by 1,000 cuts sort of fall and crunch, and I think it took 15 months rather for the market to go from its high down to its low. It was this drawn out process that was really ugly and horrible, and so federal government pumped in lots of money through the various schemes, and the Reserve Bank coming out there 2024. But actually, what we saw was markets dropped, and they actually bounced back really quite quickly. The federal government stimulus, putting a whole lot of people in money in people's pockets, rather supporting small business. Actually, people were pretty cashed up. I mean, I've seen charts out of the RBA showing the savings rate. The saving rate's never been higher. And so maybe when they hit that 2024, they were preparing for another GFC, but actually it wasn't the right medicine for that particular illness, and the bond market's saying it ain't going to happen, but the Reserve Bank is saying, well, you want to bet? And I mean, $1 billion in one day, it'll be. Let's see where it all goes.
My money's on the market.
Interesting.
Yeah.
Well, look, mate, we better wrap this one up. We've been going for a while, but look, thank you very much for listening. Thank you for everyone who jumped on the live stream. Of course, if you're watching this live on YouTube, but if you're watching it later on YouTube as well, be sure to give it the thumbs up and throw in a comment too. But of course, I know that most people get this via the Financial Autonomy podcast. So to all the wonderful podcast listeners, thanks very much. Of course, make sure you're getting the Friday email, the Gaining Choice email, which you can pick up, financialautonomy.com.au/gaining choice. All right. Thank you, Andrew. Andrew Dresner, Mercury Wealth, you've been listening to. Thank you very much for jumping in and giving us your thoughts on market noise.
Yeah, no worries. Thanks, Paul. Thanks for having me, mate.
Beauty. See you guys.
Cheers.